Welcome to Factful Finance, where we're dedicated to helping you build a secure and prosperous future. Today, we're diving into the world of investing with confidence, especially for women, focusing on how you can take control of your financial destiny through the stock market. Now, here's a fact that may surprise you. Studies show that women are just as capable of succeeding in the stock market as men, but many still hesitate to dive in. Why? Well, myths around risk and uncertainty often hold us back, but it's time to set the record straight and build the confidence you need to take charge of your investments. Before we go any further, a quick reminder: this content is for educational purposes only. We do not endorse any specific apps or products. Always consult a financial professional for personalized guidance tailored to your unique situation. All right, let's get started. Investing in the stock market is one of the most powerful ways to build wealth. It's how people grow their money over time, and yet many women avoid it due to common misconceptions. You may have heard, investing is too complicated or the market is too volatile. These are myths. With the right knowledge and approach, you can invest wisely and confidently, just like anyone else. First, let's break down some of the types of investments you'll encounter. 1. Stocks. When you buy a stock, you're essentially purchasing a small ownership in a company. Stocks have the potential for high returns, but they come with higher risk. 2. Bonds. These are loans that you give to companies or governments, and in return, you earn interest. Bonds are generally lower risk than stocks, but they also tend to offer lower returns. 3. ETFs, exchange-traded funds. These are a bundle of different investments, like stocks and bonds, in a single product. ETFs are a great way to diversify without picking individual stocks. Number 4, mutual funds. Similar to ETFs, mutual funds pool your money with other investors to buy a collection of stocks and bonds. However, mutual funds are typically actively managed, which can lead to higher fees. The beauty of these investment types is that each one offers different levels of risk and return, so you can build a portfolio that fits your unique goals and risk tolerance. Speaking of risk, let's talk about how to approach it. Understanding your risk tolerance is critical. If you're someone who gets anxious about market fluctuations, you may prefer a more conservative approach with bonds and ETFs. If you're comfortable with the ups and downs, investing in individual stocks could offer more growth potential. Remember, there's no right or wrong answer here. It's about what aligns with your financial comfort zone. And this leads us to diversification, one of the most important principles in investing. Imagine you're putting all your eggs in one basket. If that basket drops, you risk losing everything. But when you diversify, you're spreading your eggs across many baskets. That way, if one investment doesn't perform well, others might. This reduces your overall risk. So how do you actually get started with investing? Let's walk through it step by step. 1. Open a brokerage account. This is where your money will live when you buy stocks, bonds, or ETFs. Many brokerage accounts today are user-friendly and have no minimum deposit requirements, which makes it easier than ever to start. 2. Set up automatic investments. One of the easiest ways to start investing is by setting up automatic transfers to your investment account. Even just $50 a month can add up over time with the power of compound interest. 3. Use robo-advisors. If you don't feel confident picking investments yourself, robo-advisors are a great option. These are online platforms that automatically manage your portfolio based on your risk tolerance and financial goals. 4. Start with low-cost index funds. If you're unsure where to begin, index funds and ETFs are fantastic options. They give you exposure to a broad range of investments at a lower cost, which is ideal for beginners. Now, let's take a moment to reflect. Investing isn't a get-rich-quick scheme. It's a long-term strategy that requires patience, discipline, and consistency. But with time, your money has the potential to grow in ways that savings accounts and bonds simply can't match. To bring this to life, let's look at a real-world example. Meet Emma, a 32-year-old woman who's ready to take control of her financial future. Emma decided to start investing after reading about the importance of compounding returns. She opened a brokerage account and set up an automatic monthly transfer of $200 into a diversified portfolio of low-cost ETFs. After 10 years, Emma's account grew by over $60,000 thanks to consistent investing and the power of compound growth. You can do the same regardless of your starting point. The key is to start now, even if it's just a small amount. As we wrap up, I want to leave you with this. Investing is an essential tool for long-term financial security. The sooner you start, the more your money can work for you. Don't let myths or fears hold you back. Take charge of your financial future with confidence. What's the first step you'll take toward investing with confidence? Let us know in the comments. Thank you for joining us on this journey to financial empowerment. If you enjoyed this video and want more practical tips and insights, don't forget to like, subscribe, and click the bell so you don't miss out on future content. We think you'll love the video shown on screen next. It might just help you take the next step in your investment journey. Until next time, stay empowered, stay informed, and keep building the financial future you deserve.